Hey everyone, Iggy here from the Investing Iguana. So today we're diving into something that's been buzzing around the Singapore investment scene, Coliwoo's IPO. And I've got to be honest with you, when I first saw the headlines about this co-living giant going public, I was intrigued. A company that grew revenue by 85% annually, market leader with 95% occupancy, that sounds pretty compelling, right? But here's the thing, and this is why I wanted to walk through this with you today. When you actually dig into the numbers, when you really look at what's behind that growth story, it gets complicated. Really complicated. And I think a lot of retail investors might jump into this without seeing the full picture. So grab your coffee, settle in, and let's figure this out together. We're going to look at the growth story, yes, but we're also going to talk about the massive debt burden, the valuation puzzle, and honestly, why I'm personally sitting this one out. And by the way, if you want all the detailed tables, breakdowns, and my full written analysis, everything's on my Substack. Links right below. Let's start with what got everyone excited in the first place. Coliwoo's revenue numbers look absolutely stellar on paper. We're talking $15.3 million back in FY 2022, jumping to $52.2 million by FY 2024. That's an 85% compound annual growth rate. The first half of FY 2025 hits $23.1 million, which puts them on track for around $46 million for the full year. Now, they're operating 25 properties across Singapore. That's 2,933 rooms total. And here's what really stands out. They're maintaining over 95% occupancy. That's way above the industry break-even point of 70 to 75%. So you've got this picture of a company that's growing fast, filling rooms consistently, and dominating their market. And they really are dominating. Singapore's entire co-living market has roughly 9,000 rooms across 20 operators. Coliwoo holds a 32% market share, making them the clear leader ahead of the Assembly Place at 23%, a lift by Ascot at 17%, and others like Hamlet and Bespoke Habitat. How did they get there? Aggressive expansion. Between 2021 and 2022, when rental rates were surging, parent company LHN Group added 6 co-living assets. They timed it well, I'll give them that. They captured that wave of demand and rode it to the top position. Looking forward, Coliwoo wants to expand to 4,000 rooms by end 2026. That means adding about 800 rooms every year. They're planning to use a mix of owned properties, master lease agreements, and management contracts. And historically, that master lease model has delivered strong margins. We're talking 65% to 85% operating margins because you don't need much staff and you're hitting high occupancy. So that's the growth story. Pretty compelling, right? But now let me show you where things get really interesting. And by interesting, I mean concerning. Let's talk about the debt, because this is where the whole story changes. Coliwoo's balance sheet shows $252.5 million in total debt as of August 2025. Against that, they've only got $28.4 million in cash. So net debt is $224.1 million. That's nearly 4.3 times their entire FY 2024 revenue. But it gets worse when you look at the gearing ratio. With shareholders' equity of just $76.8 million, we're looking at a debt-to-equity ratio of 329%. Let me put that in perspective for you. Parent company LHN Group operates at 56% leverage. Coliwoo is running more than 6 times the leverage of its parent. Now, the IPO is supposed to help, right? They're raising $96.2 million in net proceeds. But here's what bothers me. Only about $22 million is going toward debt repayment. The rest, about $840 million for property expansion through master leases, and another $34 million for potential joint ventures and acquisitions. And this raises a really important question that I kept coming back to. Why prioritize expansion over paying down debt when your gearing ratio is over 300%? I think the answer is they feel they have to keep growing aggressively to maintain market share. Companies like the Assembly Place and Dash Living aren't standing still. If Coliwoo stops expanding, they risk losing their leadership position. But that creates this tension, right? The business model demands growth, but the balance sheet desperately needs deleveraging. And I'm not sure they can do both successfully at the same time. Let's think about what this debt cost them. Assuming a 4% average interest rate, which is probably conservative in today's environment, they're facing roughly $10.1 million in annual interest expenses. With FY 2024 earnings of $33.9 million, that gives them an interest coverage ratio of just 3.4 times. That's adequate, but not comfortable, especially when you're trying to fund aggressive expansion. Now we need to talk about valuation because this is where things get really tricky. The IPO pricing at $60 per share creates a market cap of $288.5 million. On the surface, based on FY 2024 net profit of $33.9 million, that's a PE ratio of 8.5 times. That actually sounds pretty reasonable for a high-growth business, doesn't it? But here's the catch, and this is something analyst reports are pointing out. You need to use an adjusted FY 2024 net profit of $13 million for proper valuation. This adjustment likely removes one-time gains or non-recurring items. And suddenly, with that adjusted figure, Coliwoo's PE ratio jumps to 22.2 times. Now we're talking about a completely different valuation story. Industry research suggests co-living and hospitality peers trade at about 25 times PE. So Coliwoo's valuation is right in line with established players, despite being at an earlier stage with much higher leverage. And here's what really got my attention. Parent company LHN Group trades at roughly 10 times earnings on the Singapore exchange. That means Coliwoo's IPO pricing represents a 122% premium to its parent. You're essentially paying more than double LHN's valuation multiple to own a business with higher debt, narrower geographic focus, and more concentrated risk in Singapore's co-living market. Let me show you why the earnings picture is even more confusing. First half FY 2025 results showed net profit of $9.3 million, which suggests annualized earnings around $18.6 million. But wait, that's actually higher than the adjusted $13 million figure analysts are using for FY 2024. So are earnings growing or declining? At this run rate, Coliwoo trades at 15.5 times forward earnings, which removes a lot of the growth premium justification. And when you look at the historical earnings, it gets even weirder. FY 2022 showed $33.5 million in earnings on just $15.3 million revenue. That's a profit margin exceeding 200%. That's not normal operating business. That suggests one-time gains, asset revaluations, or accounting adjustments. Then FY 23 earnings dropped to $10.5 million despite 83% revenue growth. FY 2024 rebounded to $33.9 million. And now first half FY 2025 is at $9.3 million. This kind of earnings volatility makes me really uncomfortable as an investor. It suggests the reported numbers don't reflect consistent, sustainable operating profits. That's why analysts are focusing on that adjusted $13 million figure. But honestly, we don't have full transparency into what those adjustments are or whether they're appropriate. Now, about halfway through here, I want to mention that if you're finding this analysis helpful and you want to see all the reference tables, detailed breakdowns, and my full write-up, everything's available on my Substack. The link's just below this video. I've put together comparison tables, financial metrics, everything laid out clearly so you can make your own informed decision. Let's talk about how Coliwoo actually operates, because understanding the business model is crucial to evaluating the risk here. They use three primary models. First, owned properties. They own 11 properties outright. Second, master leases. They lease 10 properties under long-term agreements. And third, management contracts. They manage 4 properties for third-party owners. Each model has very different risk profiles and capital requirements. Owned properties give you the most control and long-term value, but they require massive upfront capital. With property prices in Singapore averaging $30 to $45 million for suitable co-living buildings, ownership demands either heavy debt or dilutive equity raises. Given Coliwoo's existing debt burden, they really can't take on more property acquisitions without further straining the balance sheet. Master leases are the middle ground, and this is where things get interesting. The operator signs a long-term lease with a property owner, guaranteeing fixed rental payments no matter what. Then they sublease individual rooms to tenants and pocket the spread between what they pay the landlord and what they collect from tenants. When occupancy and room rates stay high, this generates fantastic returns, hence those 65 to 85% operating margins. But here's the risk that keeps me up at night. The operator bears all the occupancy risk. If rooms sit empty, they still have to pay the landlord, When markets soften, those master lease obligations become dangerous liabilities. Think about what happened to co-living operator Selena in the United States. They collapsed under master lease payment defaults, triggering foreclosure lawsuits and property takeovers. Now, Singapore's co-living market has been resilient. During the pandemic, occupancy rates stayed between 85 and 95% market-wide. But the sector has entered what I'd call a maturation phase. Room supply increased 17% between 2023 and 2025. Private residential supply surged with nearly 30,000 new units completing in 2022-2023. All that supply has caused rental growth to stabilize after years of rapid increases. The safest model is management contracts. You manage properties for third-party owners and take a management fee, typically 15 to 20% of revenue. This is asset light and allows rapid scaling without balance sheet strain. Larger co-living operators are increasingly shifting toward this model to improve capital efficiency. But Coliwoo only manages 4 properties this way, far fewer than their 11 owned and 10 leased properties. They're staying committed to capital-intensive strategies despite the high debt. And the IPO proceeds confirm this. $40 million is going toward more master leases, not toward shifting to the safer asset-light model. Let's talk about competition because this market is getting crowded. Since 2022, the Singapore co-living sector has attracted over $1.4 billion in transaction volume. That's institutional money recognizing this as a real asset class. The Assembly Place holds 23% market share and they're expanding aggressively. Bespoke Habitat has 12% and targets middle-income professionals. Hamlet rebranded as Habit after a 2022 merger and brings international expertise. But what really concerns me is that hospitality giant Ascot, a CapitaLand subsidiary, operates the Lift brand with 17% market share. In August 2024, they completed the acquisition and conversion of Hotel G into Lift Bugis for $240 million. That demonstrates the kind of capital firepower available to well-funded competitors. Coliwoo doesn't have that financial flexibility. The top 5 operators control about 65% of the market, which means the industry is consolidating. Weaker players are getting acquired or exiting. Coliwoo's market leadership provides some protection, but maintaining dominance requires continuous capital investment, exactly what their debt burden prevents them from doing comfortably. And competition is evolving beyond just room supply. Operators are differentiating through pricing models, target demographics, amenity packages. Some have moved from all-inclusive pricing to unbundled models. Others focus on specific communities like international students, healthcare workers, or young professionals. It's getting sophisticated. Now let's talk about something critical that doesn't get enough attention. Who actually lives in these co-living spaces? Because this matters enormously for the investment thesis. Foreigners comprise 70-90% of co-living tenants in Singapore, primarily from China, Malaysia, and India. The non-resident population represents 30% of Singapore's total population and grew 5% year over year through June 2024. International students represent a significant segment. Singapore's universities keep attracting foreign enrollment, creating steady demand. Government initiatives specifically target student accommodation. Young professionals on employment passes form another core demographic. About 60% of co-living residents are under 35. These individuals often lack the capital or desire for long-term rental commitments. Here's why this matters. This foreign-heavy tenant base creates both opportunity and vulnerability. Singapore's economic health directly impacts foreign worker inflows. A regional recession, tech sector downturn, or policy changes restricting foreign employment could rapidly decrease demand. The co-living model's dependence on continuous immigration represents a systemic risk that Coliwoo can't control. Let me walk you through the IPO structure quickly. They're offering 75 million placement shares to institutional and accredited investors, plus 5.3 million public offer shares for retail. That means retail investors only get access to 6.6% of the offering. This is heavily tilted toward institutions. 9 cornerstone investors committed to 88 million shares, 18.3% of total shares at listing. That's about $52.8 million and includes names like Avanda Investment Management, Maybank Asset Management, UOB Asset Management, Value Partners, Hong Kong. The cornerstone participation shows institutional confidence. But here's something to remember. Cornerstone investors often have shorter lockup periods than management. After their restrictions expire, these large holders may sell, creating downward price pressure. Expect volatility once those lockups end. Parent LHN Group retains about 65% of Coliwoo after the offering. That's a controlling stake, which ensures alignment, but also means LHN can block major corporate actions and potentially pursue strategies that benefit the parent at minority shareholders' expense. Now let's talk about the expansion plan, because this basically determines whether Coliwoo succeeds or fails from here. They're targeting 4,000 rooms by end 2026, up from 2,933 currently. That's a 36% increase, requiring about 1,067 additional rooms. At 800 rooms per year, they need to execute across multiple properties simultaneously. The $40 million allocated for expansion through master leases and acquisitions provides some context. Assuming average costs of $50,000 or $100,000 per room for deposits and fit-out, this capital supports maybe 400 to 800 new rooms. They'll need additional debt or partnership arrangements to hit that 67-room target. And here's where it gets really ambitious. Coliwoo plans regional expansion into Jakarta, Bangkok, Kuala Lumpur, and Johor Bahru. International expansion adds complexity, regulatory risk, foreign exchange exposure. These markets have different tenant demographics, different regulations, different competitive landscapes compared to Singapore's mature sector. To me, this regional expansion strategy directly conflicts with what they should be doing: aggressive deleveraging. Each new market requires substantial investment in brand building, property sourcing, regulatory compliance, operational infrastructure. Spreading capital across 5 countries while carrying $250 million in debt creates execution risk that could derail everything. Let me give you 3 realistic scenarios for how this could play out. In the bull case, co-living demand keeps growing as Singapore attracts foreign talent and students. Coliwoo leverages its leadership to secure premium properties and maintain 95% plus occupancy. They successfully transition toward asset-light management contracts, improving capital efficiency while growing room count. Debt gets refinanced at lower rates as leverage declines. Regional expansion in Malaysia and Thailand succeeds. Revenue hits $80 or $100 million by FY 2027 with adjusted earnings of $20 to $25 million. At 20 to 25 times PE, the stock could reach 80 to 1,000. That's 33 to 67% returns. The base case? Occupancy stays strong, but rental growth slows as supply increases. Coliwoo maintains leadership, but faces margin pressure. They gradually deleverage, but keep prioritizing growth over balance sheet optimization. Regional expansion produces mixed results. Revenue grows to $65 to $75 million by FY 2027 with adjusted earnings of $15 to $18 million. The stock trades at 15 to 18 times earnings, implying still 65 to 0.75, modest 8 to 25% gains over 3 years. In the bear case, Singapore's economy slows, reducing foreign worker inflows. Co-living supply keeps growing faster than demand, pushing occupancy below 85% sector-wide. Those master lease obligations become burdensome as rental income declines, but fixed payments continue. They struggle to refinance maturing debt. Regional expansion consumes capital without adequate returns. Revenue stagnates around $55 million, with earnings dropping to, say, to $10 million due to higher interest costs. The stock re-rates to 10 to 12 times earnings, falling to 0.35 to 0.45, a 25 to 40% loss. Now let me share what specifically concerns me most about this investment. First, that master lease concentration creates asymmetric downside risk. With 10 properties under master leases, any occupancy shock forces them to keep paying landlords while room revenue declines. Their $28.4 million cash buffer provides just 3 to 4 months of operating cushion if occupancy drops significantly. Second, the earnings volatility signals either accounting complexity or non-recurring gains inflating profits. The 61% difference between $33.9 million reported earnings and $13 million adjusted earnings is massive. We lack transparency into what adjustments analysts are making and whether they're appropriate. Third, we don't know the debt maturity schedule. If significant debt matures within 1 to 2 years, refinancing risk becomes immediate. Rising interest rates since 2022 mean refinancing will likely cost more, pressuring profitability exactly when they need strong cash flow. Fourth, parent company LHN is delisting from Hong Kong and sold off its logistics subsidiary in 2023. This pattern of restructuring suggests LHN views Coliwoo's listing as a liquidity event rather than a long-term strategic move. Parents pursuing liquidity events often push subsidiaries to IPO at peak valuations. Fifth, that's $34 million for joint ventures and acquisitions bothers me. Why pursue new investments when leverage exceeds 300%? This signals management prioritizes growth and market share over financial stability, risky given the debt burden. Let me talk about competitive advantage for a minute, because this matters for long-term value. Market leadership provides advantages, but I'm not convinced Coliwoo has a sustainable moat. Yes, they have 32% market share, but barriers to entry remain modest. Well-capitalized competitors can acquire properties, negotiate master leases, or convert existing assets. Ascot's Lyft brand shows how established hospitality players can quickly capture share through capital deployment. Brand loyalty in co-living is limited. Tenants choose based on location, price, and amenities rather than operator brand. A professional moving from Orchard to Jurong will pick the most convenient property regardless of who operates it. This location-specific competition is different from true brand moats, where customers specifically seek out your products. Operational excellence matters, but competitors can copy best practices. Coliwoo's 95% plus occupancy reflects strong property selection and management, but other operators achieve similar rates. The business model, property sourcing, fit-out, digital booking, community management, none of this is proprietary or impossible for competitors to replicate. Scale advantages exist, but they're modest. Larger operators get marketing efficiencies and better supplier terms. But co-living remains a localized business where individual property performance drives profitability. A 2,933-room operator doesn't have dramatically lower costs than a 100-room competitor. The most defensible aspect is relationship capital with property owners. Having proven execution makes landlords more comfortable with master lease agreements. But this advantage erodes if financial leverage creates payment stress or reputation concerns. Here's my personal take on all this. After analyzing Coliwoo's financial position, valuation, and competitive landscape, I cannot recommend this IPO for most Singapore investors. The combination of extreme leverage, premium valuation, and execution risk creates an unfavorable risk-reward profile at lower 60s. That 329% gearing ratio is my single biggest concern. Even after the IPO, Coliwoo will carry over $160 million in net debt against shareholders' equity of roughly $95 million, still above 170% gearing. Any downturn in occupancy, rental rates, or economic conditions could trigger a debt spiral where they struggle to service obligations while maintaining operations. The valuation at 22.2 times adjusted earnings leaves almost no room for disappointment. You're paying hospitality sector multiples for a heavily leveraged operator in a maturing market. If earnings growth slows or margins compress, the stock will re-rate downward fast. That 122% premium to parent LHN's valuation requires perfect execution, unrealistic given the operational challenges ahead. The capital allocation decision to pursue expansion rather than aggressive deleveraging tells me management priorities aren't aligned with financial prudence. A company with 300% plus gearing should focus obsessively on debt reduction, not international expansion and joint ventures. This suggests they believe they must grow or die, a dangerous mindset when carrying substantial debt. Now, who might consider investing? High-risk tolerance investors who believe Singapore's co-living boom has years of runway and that Coliwoo can execute while gradually deleveraging. People comfortable with real estate and hospitality volatility. Those wanting Singapore residential property exposure without directly owning rental assets. Who should definitely avoid this? Conservative investors seeking stable dividends or capital preservation. Anyone uncomfortable with companies carrying debt exceeding 200% of equity. Investors prioritizing balance sheet strength. Anyone expecting significant near-term price appreciation, the valuation already prices in substantial growth. If you do participate, limit it to 1 to 2% of your portfolio maximum. This is a high-risk, potentially high-reward speculation on Singapore's demographics and co-living growth, not a core holding for long-term wealth building. There are several critical information gaps that bother me. We need clarity on debt maturity schedule. When do those $252.5 million in borrowings mature? The loan covenants matter too. Restrictions on additional borrowing, minimum cash levels, debt service coverage ratios. The exact terms of master lease agreements remain unclear. What rental escalation clauses exist? Can they exit unprofitable leases early, or are they locked in? The risk profile varies dramatically based on contract terms. The breakdown between recurring and one-time earnings needs transparency. What specifically causes adjusted earnings to differ from reported figures? Investors deserve clear disclosure on whether past profits reflect sustainable operations or accounting gains that won't repeat. Management's track record deserves scrutiny. CEO Kelvin Lim founded Coliwoo and leads LHN, but his decision-making during stressful periods remains untested. Co-living operators globally faced intense pressure during COVID-19. How specifically did Coliwoo perform then? The regional expansion timeline and capital requirements need definition. Which cities first? What ownership structure? How much additional capital beyond that $34 million will international growth require? Let me offer you some alternatives if you're bullish on Singapore's co-living sector. Instead of Coliwoo's IPO, consider established REITs with hospitality exposure at more attractive valuations. CapitaLand. Ascot Trust offers diversified exposure to serviced residences and co-living through LEF, trading at about 1.0 times book value, with distribution yields around 5 to 6%. Parent LHN Group itself represents an alternative. LHN will retain 65% of Coliwoo after listing, valued at roughly $187.5 million at IPO price. Yet LHN's market cap was significantly lower before the spin-off announcement. You might access Coliwoo's value through LHN shares at a discount while also getting LHN's diversified property management and other businesses. For direct property exposure, established hospitality REITs trade at 8 to 12 times earnings with much lower leverage. These offer liquidity, professional management, diversification across properties and operators without concentrated risk. Real estate crowdfunding platforms provide another avenue. Some platforms offer debt investments in co-living properties with 6 to 8% yields secured by property assets. Less upside than equity, but far better downside protection than Coliwoo's leverage structure. Here's my final thought, and this is really important. Singapore's co-living sector represents a genuine structural shift in how young professionals and foreign workers approach housing. The business model works, demand exists, and Coliwoo has proven execution capabilities. In a different financial context, lower debt, more conservative valuation, this might be an attractive investment. But great businesses don't always make great investments at any price in any capital structure. Coliwoo's excessive leverage combined with premium valuation creates a fundamental mismatch between risk and potential reward. They need several years of flawless execution to deleverage while maintaining growth, an exceptionally high bar. I'll be watching Coliwoo's post-listing performance with interest. If the stock pulls back 20-30% in the first 6 to 12 months, and if they demonstrate consistent debt reduction and occupancy maintenance, it might become interesting. But at 0.60 with 329% gearing, I'm staying on the sidelines. The investing iguana knows when to pounce and when to wait. This is a time to wait, watch, and reassess once the debt story improves or the valuation becomes more compelling. Sometimes the best investment decision is the one you don't make. So what do you think? Are you considering Coliwoo's IPO? What's your take on the co-living sector in Singapore? Let me know in the comments below. I read every single one, and I'd love to hear your perspective. And hey, if you found this deep dive helpful, consider joining my premium membership on Substack. You'll get early access to my analysis before videos drop, exclusive research reports, detailed financial models, and direct access to our investing community. We're building something special there, a group of thoughtful Singapore investors who help each other navigate these opportunities together. Links below. Thanks for watching, and I'll see you in the next one.